To execute trades accurately, we must stop looking at chart patterns as arbitrary geometric shapes. They are visual footprints. Every peak and valley is a literal record of momentum shifting between buyers and sellers fighting for control. Look at this clean structure of a moving uptrend. When the price creates two peaks at approximately the same horizontal level, it forms a resistance zone. Buyers have lost momentum and failed to push the price to a higher high. The swing low between these two peaks acts as your baseline, which we call the neckline. The exact same mechanical logic applies in reverse during a downtrend. The price pushes down into two equal lows, proving sellers are losing control. The swing high in the middle forms the new neckline. This setup dictates our baseline rule for entering a trade, the neckline breakout. You only execute your entry when the price decisively closes past that established neckline, confirming the trend has actually reversed. Waiting for that definitive structural break is the strict mechanical difference between a professional execution and blindly guessing that a trend might be ending. Live markets rarely print perfect line art. Real market data is naturally noisy. To adapt to these messy candlestick charts, we apply our second execution strategy, identifying patterns directly at major key levels. This chart shows a double top forming exactly against a thick historical resistance zone. When your pattern aligns with established daily resistance, trade quality increases dramatically because institutional money is deployed at these exact boundaries. Traders often chase the initial breakout. To mitigate risk, use the pullback entry. Wait for price to break the neckline, then naturally pull back to retest that broken level. Once it establishes new resistance and prints a downward rejection candle, you trigger your entry. By waiting for the pullback, you force the market to prove its directional shift before you risk a single dollar. You demand definitive structural proof. As market structure escalates in complexity, we look for the head and shoulders pattern. It starts in a standard uptrend with a left shoulder, pushes up to a higher peak forming the head, and then fails at a lower peak to form the right shoulder. This chart illustrates a higher quality variation, an aggressively slanted neckline connecting two unequal swing lows. Structurally superior to a flat neckline, this downward slant proves the market forced a lower low before the right shoulder finished forming, indicating early seller dominance. Because asymmetrical patterns register this loss of buyer momentum earlier than perfectly symmetrical ones, they provide traders with an advanced signal and a significantly tighter risk-to-reward ratio on the entry. Treat structural boundaries like triangles, channels, and wedges as dynamic, semi-transparent zones instead of thin lines to absorb market noise. Within these zones, an upward angling rising wedge signals a bearish reversal, while a falling wedge signals a bullish breakout. Let's test this logic directly. Pause the video and look at this raw candlestick chart. We have a strong downtrend, a descending triangle, and a closed breakout candle below support. Where is your entry and stop loss? Here is the solution. Place your limit order at the flat bottom retest, safely positioning your stop loss above. Treating these setups as rigid textbook lines is the primary reason traders get stopped out, even when their macro directional bias was entirely correct. We can now combine these structural and risk management rules into our final capstone technique, the multi-timeframe nesting strategy. This approach allows us to secure an advanced, aggressive early entry. We begin by mapping an inverse head and shoulders, forming at the bottom of a downtrend on a macro daily chart. This gives us our broader context, establishing that a large-scale bullish reversal is taking shape. This chart layout shows the macro daily structure, but notice the inset box magnifying the right shoulder. Instead of waiting for the daily timeframe to play out, we zoom down to a lower intraday timeframe, specifically inside that forming right shoulder, to hunt for an immediate entry trigger. Inside that inset, we find a localized descending triangle. The moment that microstructure breaks out upwards, we execute the trade. This triggers our early entry well before the heavy macro neckline on the daily chart even registers a break. To tie this entire system together, take a look at this reference matrix, mapping the core pattern types against our execution rules. This cheat sheet gives you a mechanical framework to adapt to any market condition. Mastering chart patterns does not require memorizing rigid geometric shapes. It demands strict mechanical execution of your risk management strategies within the dynamic zones where buyers and sellers are fighting for control.